Picture this. One morning, you try to withdraw cash, but the ATM says, "Transaction denied." The branch is closed, your account is frozen, and your life savings are trapped. This isn't a movie plot. It's exactly how a failing bank goes down, and most people never see it coming. Today, we're revealing 10 signs your bank is going out of business soon. From subtle red flags to undeniable warning shots. Hit subscribe right now, because what you learn today could be the difference between protecting your money and losing it all overnight. Sudden withdrawal limits. When your bank suddenly limits daily or weekly cash withdrawals without warning, it's often more than a security measure. It's a sign they're struggling to keep enough cash on hand. Healthy banks allow easy access to your funds, but troubled ones may quietly restrict withdrawals to slow the outflow of money. These limits help preserve liquidity during financial strain, but they also reveal underlying instability. In extreme cases, this move can precede a bank run, where too many customers withdraw at once, risking collapse. If your bank imposes withdrawal caps without clear explanation, pay attention. Combined with other unusual changes, it could indicate a looming crisis, and you may want to consider moving your funds before access becomes even more restricted. Branch closures, without clear reason. Closing a branch occasionally is normal for operational efficiency, but when multiple branches shut down quickly, especially in profitable locations, it's often a red flag. Struggling banks may slash operating costs by closing physical locations, reducing service hours, and shifting customers online. While this saves money, it can also point to declining revenue or rising unpaid loans. Rapid closures often happen quietly, with little public explanation, but they impact customer access and confidence. In some cases, widespread shutdowns precede mergers, acquisitions, or even bankruptcy. If your bank is closing branches in busy areas or eliminating services you rely on, it's worth investigating their financial health. Paired with other warning signs, this could be a strong indicator that trouble is brewing behind the scenes. Drastic changes in interest rates. Sudden jumps in loan rates or unexpected drops in savings account interest can be more than market fluctuations. They can signal that your bank's finances are under stress. Troubled institutions might hike loan rates to generate quick cash or slash savings rates to reduce how much they owe depositors. These moves are especially suspicious if they happen out of sync with other banks or central bank policy. In some cases, unusually high deposit rates are used to lure in fast cash, which can be a desperate attempt to shore up liquidity. If your bank's interest rates change dramatically without a clear economic reason, take notice. It might be a sign that they're scrambling to stay afloat and keep operations running. Frequent technical glitches. Occasional outages happen at any bank, but repeated technical issues are worth concern, especially if they affect access to your money. Frequent ATM errors, online banking downtime, or delayed payments may point to cost-cutting in IT systems or deeper organizational problems. In severe cases, banks may disguise liquidity freezes as system upgrades to temporarily stop withdrawals. If you find your bank's app offline during business hours or ATMs frequently out of service, track the pattern. Reliable institutions prioritize system stability. Struggling ones may let maintenance slip or use outages as cover for larger problems. Combined with other warning signs, persistent glitches can be an early indicator of operational and financial trouble that the bank isn't openly acknowledging. Rumors of government intervention. When reports emerge that regulators are in talks with your bank, it's rarely a false alarm. Governments and financial watchdogs step in when a bank's capital reserves fall dangerously low or risky lending threatens its survival. These interventions can range from quiet oversight to full control, but even the possibility can spark customer panic. News leaks about emergency funding or insider warnings are serious indicators of instability. While intervention may save the bank, it often comes with account freezes, access restrictions, or forced restructuring. If you start hearing repeated, credible reports of regulatory involvement, consider it a major warning. This may be your signal to safeguard your funds before any official announcements make withdrawal difficult or impossible. Declining stock performance. If your bank is publicly traded, its stock price is an open window into investor confidence. Persistent declines, especially when worse than industry peers, can reflect deeper financial issues, from poor earnings to mounting legal troubles. Sharp drops often follow revelations about bad loans. risky investments, or regulatory penalties. While markets fluctuate naturally, steady underperformance compared to competitors should not be ignored. Analyst downgrades or negative forecasts can create a self-reinforcing cycle, pushing the stock even lower. This matters for customers too. Weak investor confidence can impact a bank's ability to raise capital and continue operations. If your bank's stock is falling significantly over time, it's worth treating as a potential early sign of trouble that could eventually affect depositors. High executive turnover. Stable banks value consistent leadership, so when top executives resign or are replaced in quick succession, it's a possible red flag. Rapid turnover at the CEO, CFO, or other senior levels often points to internal disputes, strategic disagreements, or external pressure from regulators. In some cases, leaders depart to avoid being associated with impending failure. Official statements may frame exits positively, but multiple resignations in a short span often hint at deeper problems. Leadership instability can disrupt strategy, lower employee morale, and erode customer trust. While one change might be harmless, a series of them combined with other financial stress signals could indicate that the institution's foundation is far less secure than it appears on the surface. Poor credit ratings and reduced customer services. A sudden downgrade from agencies like Moody's, S&P, or Fitch is a red flag, signaling the bank's rising risk and higher borrowing costs. This financial strain often spills into visible changes: shorter teller hours, fewer staff, and reduced services. While each sign alone may have explanations, together they point to deeper trouble. Downgrades weaken trust, and service cuts suggest cost-saving survival mode. If you see both happening, it's a strong signal your bank may be under significant financial pressure. Aggressive loan collection. A bank that suddenly tightens loan terms or becomes overly aggressive in collecting debts might be under stress. This can include refusing extensions, raising penalties, or even calling in loans early. While protecting assets is normal, a sudden shift toward harsh collection practices may mean the bank needs quick liquidity to stay operational. These measures can strain customer relationships and signal desperation. If this change happens without broader economic shifts to justify it, it's a cause for concern. Such behavior, especially when paired with other instability indicators, could be a sign your bank is scrambling to recover financially and is willing to risk alienating borrowers to survive the short term. Sudden changes in terms and conditions. When your bank quietly revises its terms, especially regarding fees, withdrawal access, or loan rules, it's worth a closer look. Troubled banks may add clauses that allow them to delay withdrawals, increase charges, or limit services without much notice. These changes are often buried in dense documents or vague emails. While some adjustments are routine, a cluster of restrictive updates in a short time can be a warning. Comparing old and new terms can reveal if the bank is prioritizing its own survival over customer convenience. If the new rules reduce your access or control over your funds, it's a strong signal that the institution may be bracing for turbulent financial times ahead. Bank collapses rarely happen overnight. They leave warning signs for those who know how to read them. Spotting these early can help you protect your money and avoid unnecessary risk. Got thoughts or questions? Drop them in the comments. I read every single one. Share this with a friend who needs to see this. Subscribe now so you don't miss what's coming next. Trust me, it's worth it.